a $8 premium. Shanghai is paying $82 while COMEX sits near $76. That gap is not noise, that gap is structure, and it is widening. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, silver moves while markets are closed. Let's get straight into it. Silver trades at $76.08 per ounce Sunday morning. Shanghai physical trades near $82.11 equivalent. That is a $6 to $8 spread. That is 9 to 12.7% premium. This is not a one-day spike. This is persistent across sessions. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today, Shanghai Gold Exchange pricing versus COMEX futures, 82.11, SGE AM fix on April 30th, 75.36, COMEX spot on May 3rd, premium holds between 675 and 875, effective across multiple sessions. This follows ongoing import quotas in China. This follows 13% VAT on withdrawals. This follows rising industrial demand from solar and EV production. The unusual detail is persistence, not the premium, the persistence. Week after week without collapse. The timing is what deserves scrutiny, not the premium itself. The timing. Think about what that sequence actually means. Physical demand is not slowing. Paper pricing is not adjusting. Those two do not stay disconnected forever. What happens when that gap forces convergence? The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time physical premiums held above 10%, supply chains broke within quarters. The data is already telling you something. Let's build it out. Now let's build the full picture because Shanghai pricing does not exist in a vacuum. COMEX warehouse data has dropped. Registered silver stands near 77 to 80 million ounces. Total open interest sits near 550 to 575 million ounces. That is 13 to 14% coverage. Source, CME Group COMEX warehouse reports. Source, CME open interest data. In January 2026, 33 million ounces exited registered in 1 week. That is 26% of the pool. Source, CME Daily Warehouse Stocks Report. That is not a normal move. That is a stress signal. Compare that to 2020 levels above 150 million ounces registered. That is a near 50% structural reduction. At the same time, World Silver Survey 2026 reports a 46.3 million ounce deficit. Source, Silver Institute Annual Report. Over 5 years, 762 million ounces removed from above-ground stocks. That is cumulative drawdown. That is not seasonal fluctuation. The rate of depletion is not slowing. It is compounding. The data is doing the talking. The ones who were dismissed for calling physical tightness, they are not saying much right now. And here is what makes that picture even harder to ignore. Registered coverage ratio sits near 13%. Stress threshold sits at 15% historically. At the same time, paper open interest remains elevated above 550 million ounces. That is not a contradiction. That is the setup. And before anyone takes that as a green light, setups take time. Sometimes months, sometimes longer. What this tells you is structure, not timing. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now here is the number most people are not talking about. 98.18 on the dollar index. That level matters. Now the macro variable, currency and rates, because this is no longer a backdrop. It is the primary variable. US dollar index sits at 98.18. Source, ICE DXY index data. That is a 2-month low, driven by yen intervention Friday. Source, Bank of Japan currency operations. 10-year Treasury yield sits at 4.35%, down 10 basis points from recent highs. Source, US Treasury data. Gold trades at 4,623, up 42% year-on-year. Source, LBMA pricing data. Energy markets hold inflation premium due to Iran tensions. Source: global oil benchmarks data. That is the cost layer. Higher energy means higher input costs. Higher costs support metals. Markets are still pricing stable macro conditions. Look at falling yields and tell me what probability you assign to that stability. When markets reprice currency weakness, metals move higher. When real yields fall, metals move higher. That is the historical pattern. Every time dollar weakness aligns with physical tightness, silver reprices higher. It has not been different yet. Silver Western spot at $76.08. Shanghai equivalent at $82.11. That is roughly $6 to $8 premium. Short-term picture remains unstable. Weekend gap risk is elevated. Asian markets open first. Shanghai reopens before COMEX. That sequence matters. If Shanghai premium holds above 9%, upside pressure builds. If premium compresses below 5%, pressure eases. If COMEX registered falls further, squeeze narrative strengthens. If registered stabilizes, price may consolidate. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. Current environment remains headline-driven and reactive. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. Iran tensions ease and oil drops sharply. Real yields rise above 4.5% again. COMEX registered stabilizes above 80 million ounces. The bull case is equally real. Shanghai premium holds above 9% multiple sessions. COMEX coverage remains below 14% without recovery. Silver Institute deficit continues into 7th consecutive year. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything I showed you today points to one thing. Physical demand is tightening while paper supply remains elevated. That imbalance resolves eventually. The only question is when convergence happens. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group COMEX reports, Shanghai Gold Exchange data, Silver Institute annual survey, logic over hype, always. If this analysis added value, like this video right now, subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. The ones paying attention already see the structure forming. The ones who verify do not argue about it. Sit with that. OG John AG 1.0, out.